Good day, ladies and gentlemen. Welcome to IPE Real Assets. I'm Brendan Mayton for IPE. Today, I'm delighted to answer all your questions, everything you wanted to know about infrastructure, but were too afraid to ask. The person who will be answering all your questions today is Professor Frederick Blancrude from Edek Infra. Hello, Frederick. Welcome to the IPE channel.
Hello, Brandon. Thank you.
Frederick, I think you said before we went on air that one of your aims for today was to inform the audience, so much so that they'll be able to go to any dinner party and talk confidently on infrastructure. That's what we're aiming for over the next 60 minutes, correct?
Well, dinner party is the ultimate goal, really. If we can get some information in about, about these sort of key topics that people keep bringing up at conferences, they might find it useful on the next panel, perhaps the next board meeting. If they can still remember and use this information at a dinner table, I hope they'll send me an email afterwards.
Excellent. Excellent. Well, you say send an email. They might send an email in the next 60 minutes. They might not wait till later because this is a live interactive debate. IPE Real Assets really welcomes contributions from the audience. I know that Edek does. So if you've got any questions, comments, or challenges for Professor Blancrude, then do fire them in. Please put your name and the organization you represent. That's very important to us here at IPE Real Assets. But Frederick, let me start by saying that infrastructure still remains super popular. I think Swiss pension fund legislation has recently changed, made it more popular. And well, Solvency II, another example, going back a few years, favorable conditions for treatment of infrastructure equity. The interest continues to grow, correct?
It continues to grow beyond the pioneers of the last couple of decades. I think this is now something that almost every single plan, every single investor with 5 billion of AUM is looking at for all the obvious reasons, in particular, their inability to continue to have all these negative yielding bonds.
Yeah. Well, those conditions don't change. Infra looking attractive. And let's cut to the chase here, Frederick. The secret underneath everything you're going to teach us today is Edek Infra's TICCs. Now, should I say TICS or TICCs?
TICS.
TICS. This is the fact set upon which all the research into infrastructure done by you and colleagues, and presumably clients who sign up to it, is based, right?
That's right. So TICS is, it's really boring when you think about it, but it's really useful. It's a taxonomy of infrastructure companies. And that's because over the years, we had to collect a whole bunch of data. And the more we collected, I'll show you, we've collected quite a lot. The more we collected, the more we realized, oh, we need a system to organize this information. So we called it TICS, the Infrastructure Company Classification Standard. And we published that a couple of years ago. And to my surprise, but perhaps I shouldn't have been so surprised, this was an instant success. A lot of investors decided that, oh, they needed this particular taxonomy in order to organize their own portfolio, in order to compare their portfolio holdings with our data, because of course it's plug and play. From the moment you use the same taxonomy, everything becomes easily comparable. And also to implement as a tool to create analytics. So for example, some of the largest asset managers in the world, not to name them, use TICS in their own information system. So that's what allows us to make our data the most usable for the industry.
Okay, super duper. And just to remind the audience, pretty standard IPE Real Assets format, guys. I'm going to hand over to Frederick to present in a couple of minutes. But within his presentation, as you'd expect, from a professor at a business school, there will be questions for you, the audience. We're going to have some audience polls, 3 in fact, and there's also going to be a lot of Q&A from Frederick answering lots of your questions. I suppose, Frederick, the important thing about having this taxonomy you founded Edek Infra 5 years ago, is that it gets past all of those big questions people want to know when they're looking at infra. So lack of transparency, it's just so much harder to compare than public securities. The sort of idiosyncrasy of infrastructure investments, the paucity of comparisons available, all of that gets tackled by TICS, right?
Exactly. That's exactly what we're trying to address and solve, because it's not all idiosyncratic, of course, far from it. And it can be much more transparent than it currently is. So let me show you.
Yeah, this will become super apparent. Before I do that, I just want to introduce a bit of topicality or an observation which you've drawn out, which is that basically since 2016, infra's sort of tailed off a bit, and that's something that users of TICS can find out. I think it's evident in your index, the Infra 300 index. It's not so attractive over 5 years as an asset class. I'm pausing, guys, because few people buy an asset class, but less attractive over 5 years than 10. Is that fair to say?
Okay, so there are two phenomena going on here. One is that, let's say 15 years ago, infrastructure was fairly cheap and then became the object of the desire of many investors. And as they bought and bought and bought infrastructure, it became priced differently. It's the same thing. It has the same risks, but the price of these risks has changed. It's decreased, to be clear. And so the value has increased. And so there were quite significant capital gains in this across the sector as this asset class came out of its little niche and became more mainstream. But that could only last for so long. Also, that's a good thing that it becomes priced, so to speak, by the market at the level that buyers and sellers are willing to bear, but it doesn't go on and on and on forever, because that's usually a bad sign. So we see in the data that after, it kind of starts in 2016, but it really tails off after 2018, so not that long ago. Prices effectively stop increasing all the time. And then since then, infrastructure has been what I would consider, in fact, to be reasonably fairly priced. But and then in the past couple of years, we've had COVID, which has been pretty impactful in some sectors, and these are some of the largest sectors in terms of capitalization. And we've also had more recently increasing interest rates, which does bad things to long duration assets. So yes, in a shorter period, there's been some serious volatility and some losses, but it doesn't mean that it's completely lost its historical characteristics. It's more that we're now starting to see what it looks like over a longer period of time.
Yeah, don't worry, Frederick. I'm not dissuading people from investing in infra, but anyone who's heard you speak before will have seen embedded in that answer you've just given us some big themes. In other words, good for the market to decide the price. That's the way it ought to be, in line with international accounting standards. Don't want the stale pricing, the fantasy pricing of appraisals or book value. And another nice point that you got in there about fluidity of buys and sells. I like that very much. Why don't I hand over to you to present and just warn the audience again that we'll be having some audience polls testing your knowledge, your thoughts about infrastructure during Frederick's presentation. But for now, Frederick, over to you.
Okay. Can you just confirm that you can see the slides?
Yep, all is good.
Okay, there we go. So this is me. Well, I guess you could read that later. I think you'll have those slides afterwards. And again, well, let me just tell you very briefly what you haven't heard yet from Ian, which is that from Brandon, sorry, which is that so Edek business schools started looking at infrastructure as a research topic in the context of what at the time was Edek Risk Institute. Many years ago, in fact, 2012. And then increasingly, this topic became a big topic for us. And we started also to raise significant research funding for this topic. And so we created Edek Infra. And I had a team at the time, but it became a much bigger team. So it's now about 25 people. And so it's a research center that does research on infrastructure investment, obviously, collects data, writes papers. But for the past year and a half, our research has reached a level of maturity, so to speak, such that we can now provide it to the market as a product. So we also created a business, which now creates, publishes, and provides data and index data and analytics to many investors in infrastructure. And I'll at the end of this talk, I'll give you a little overview of what we do for our clients. But just also as a by way of background, what we've done for the past 5 years is collect and map the investable market. So we've determined in all the most active markets, so the 25 countries in which there's the largest numbers of transactions in the secondary market for infrastructure, unlisted infrastructure. We've identified the entirety or almost the entirety of the investable universe. So that's several thousand firms, close to 7,000. And these are uniquely identified companies, and they're real companies you can buy. And then we've extracted from this universe a sample of roughly 650 companies and over 2,000 debt instruments, which is the debt of these companies, which we then use to build indices. For example, we build this Infra 300 index, which is designed to track this entire universe and match its various components. So let me just show you this index, which Bernard was mentioning, is published every quarter. It's in fact computed every month now. And of course, without getting too much into the sort of commentary about this particular index, it does have characteristics that are familiar to infrastructure investors. It has pretty good returns, and more importantly, it has pretty good risk-adjusted returns if you compare with other asset classes. But yes, in recent periods, it's been fairly volatile. And that's in part the impact of COVID on cash flows, but also on risk premium. I'll come back to this. Anyway, that's an index that's available for free on our website and also in Bloomberg. And just to finish on this index is built to match this universe, right? So we have this universe by, for example, on the left-hand side, you have a little chart which shows you the breakdown of the universe by business model, what we call business models, so contracted assets, merchant assets, etc., regulated assets. In the middle, you have a breakdown by industrial activity, so sectors. And on the right-hand side, you have a breakdown between corporates and projects, infrastructure, project finance, or corporates. And here you can see that the match isn't perfect because there are some limitations to how much data and high quality data we can get to produce the information that we produce, but we're getting pretty close, right? And also this is transparently a good match, but not the perfect match for the universe. Anyway, that's what we do. We have all this information and we use it to produce asset valuations, measure performance, measure risk, and produce various analytics on this asset class. Okay, now let me get to the meat of this presentation, which is those 10 things that you may or may not have asked yourself before, and which may come handy at the next dinner party or at the next roundtable. I'm not going to go through the list now, but as you'll see, there's a bit of a progression through this list. We're going to start with the basics, what infrastructure is like, or what infrastructure companies are like, then how we might understand their performance, how we might benchmark their performance, and then finally, how you might benchmark the actual investments, either a fund or a portfolio, and the pricing and the role in the portfolio of the asset allocation of infrastructure assets. All right, so let me start on this with my first one. Are infrastructure companies cash cows? So this is something that sometimes read as a bit of a controversial thing, right? Because infrastructure companies are not meant to make too much money. They're meant to be making some money, but given that they also provide public services, that they are regulated, cash cow doesn't always come across as the best terminology. But it's a good question. And so we looked at this in a great deal of detail in a very recent paper. But first, before I tell you the answer, we have a poll question. So Brandon, if you can fire up the first poll question, please, which is very much this question.
Yeah. Let's bring it up for the audience.
What do people think? Are infrastructure companies cash cows?
Well, the poll we have, just to be clear, Frederick, is what's the typical dividend revenue ratio of a mature infrastructure company? Yeah,
which is a sort of technical version of the same question.
For anyone who's confused, who doesn't see cash cow in the poll. And you've got a range, you've got 5 choices there, guys: 5%, 10%, 15%, 20%, 25%. Okay. Now, this is obviously based on all of your data, Frederick, just to state the obvious, yeah?
Yes, well, it's based on this paper. We looked at infrastructure companies and we looked at their accounts in a great deal of details, and then we built a comparison with other companies. We built various samples which had the same characteristics, the same size, the same leverage, the same profitability. We found a whole bunch of other companies, basically either public or publicly traded or private, which looked very much like our infrastructure companies, except that they're not infrastructure companies. And then we start to compare a number of their characteristics. For instance, the relationship between operating leverage and financial leverage, and the flexibility of the assets, the liquidity of the assets, etc. There's a whole bunch of typical measures that you can look at. And in the end, how much dividend they paid as a fraction of their revenue. And this is where it got really interesting.
Yeah.
So I don't know how many answers you're seeing. How many... Are we getting a large sample for our survey?
Yeah, you've got 91 respondents.
Okay, that's qualify as a large sample.
Yeah, it's gone up to 92 while we spoke. And just to be clear, before I end this poll, folks, this research is by colleagues of Frederick, Tim Whittaker and Rebecca Tan. It's at the bottom of that slide. But their full paper is one of several which are available for you to download as attachments to this webcast, because Edek Infra likes to educate and it likes to empower asset owners and asset managers. So you're welcome to download Tim and Rebecca's paper. But before then, let's end this poll. And Frederick, you just give me your immediate response to the answers. Yeah, the 15%. I mean, anything above 10%.
So sorry, I don't think I can see the answers. What sort of...
They're in the side margin. If you click on that
poll.
Oh,
sorry, yes, I've got it, sorry. Yes.
Have you got them now?
So most people would say 5 to 10, huh?
Yeah.
Guys, I'm not sure there are many investors in infrastructure in the crowd. The answer is 20 to 25%, okay? And this is what is truly remarkable and truly unique about these companies. These companies have very high dividend payout ratios. Of course, in the first few years when they get built and they kind of ramp up to their business case, they don't pay that much dividends. But once they mature and they're operational, they're in a position to pay very high dividends. That's because of the economics of infrastructure companies, of course. The whole idea is to sink a whole bunch of capital, usually into the ground, up front, and then you get repaid over a long period of time. You have limited reinvestment options, and so most of the behavior of these companies consists of paying out the free cash, a significant proportion of the free cash. It's more true for projects or anything that has a limited life, a time-bound type of investment. But even the large the large privatized utilities and airports, etc., they have an ability to pay out a lot of cash, even if they retain some cash for future capex. The payout ratios are very high, and so this is going to make infrastructure unique. Basically, that's it. Because this is why it's going to behave differently than other assets.
Can I just?
Are you leading me on to move on to the next one? And so if you want to know more, just as a side point, on our platform, we have all these analytics on the cash flow characteristics of infrastructure, including, for example, the dividend to revenue ratio of these firms during their life cycle or during the calendar time, etc. Okay, second question. Is infrastructure an inflation hedge? So here I have another poll question for you. It's a simpler structure, I think, either yes or no.
There it is.
Brandon,
we've got a few.
Hit them with it.
We've got people can sit on the fence with probably not. I'll read them out to you. I mean, I think the audience can see them, Frederick, but there we are. Yes, is unlisted infra equity an inflation hedge? Yes, I think so. I can't be 100% sure. Option C, probably not. Option D, no, it doesn't work as an inflation hedge. And of course, lots of people, well, they may not be infra specialists, but they will have, there's lots of academic literature on whether equities in total, that's public equities, are an inflation hedge. Here come the answers.
Okay. It's 50 answers. That's pretty good. Can probably do a bit better than that. So this is, of course, this has been one of the major reasons, at least historically, for the large Canadian plans, for example, getting into infrastructure, because they have inflation-linked liabilities, and they are interested in finding inflation-linked investment. And it's almost like the way that every single pitch ends. Infrastructure, it's da-da-da-da-da-da-da-da, and it's an inflation hedge. It's probably the one thing that gets repeated the most often. 100 answers. I think that qualifies as a large sample. And we have 40% who are sure of it and 40% who think it's probably the case. So that's most people. Oh, well, once again, I don't think we have enough infrastructure investors in the crowd, because the answer is no, probably not. So let me try and explain that. First, infrastructure, then that's usually the initial belief, tends to have revenues that are, the infrastructure companies tend to have revenues that are correlated with inflation. And that's because they're given some kind of revenue pass-through, right? So if the CPI level or RPI level is at some level, their tariffs increase or something like that. Also, they have pricing power because they're quasi-monopolies, except quasi-monopolies are usually regulated. So the regulator will also have a word to say, something to say about how you set the tariffs. Anyway, these inflation pass-throughs, they're not universal. Many projects don't have them. Many infrastructure companies don't have them. And when they exist, they're usually limited or capped. So typically in the UK, you have water companies or gas companies that can ask for an inflation pass-through, but the regulator will give them RPI minus X, X being some degree of efficiency gains that they're supposed to achieve during the next regulatory period. So they're not getting RPI, they're getting RPI minus something. So first, you must remember that revenues are not perfectly correlated with inflation in infrastructure, at least not across the board. In some cases they are, in some cases they are not. And then the other important thing is that investors should be thinking about dividends, of course, equity investors, not revenues. What the cash flows they're going to receive, which will drive the value of their asset, of their investment, which will be discounted at a rate which changes with inflation, to the extent that interest rates move with inflation. These dividend streams are not completely, or if at all, correlated with the revenues. In fact, this correlation is easily lost, because from the revenues all the way down the cash flow waterfall, there are lots of other things going on: senior debt, OPEX, CAPEX, etc., reserve accounts. And by the time you've paying out dividends, the statistical correlation between revenues, RPI or CPI, and dividends is pretty low. In fact, it's not there. So that's one reason to doubt this story, which is that the cash flows themselves, the dividends, are not particularly correlated with inflation. However, inflation is important precisely because it tends to be correlated with interest rates, right? So when inflation goes up, interest rates, or everything else being held equal, interest rates go up. And that will hit the discount rate of those assets. And usually more so than the dividends will be correlated with inflation. Therefore, an inflation hedge a little bit, but probably not that much. In fact, if you want to understand this better, you can look at this kind of analysis that we do every quarter. We break down the change in net asset value. So this is the average change in net asset value in Q1 across 530 assets in 25 countries. Obviously, it's negative because this was a bad quarter. And in particular, interest rates were up. Interest rates were up across the board and across the term structure, meaning that the impact on the NAV, was fairly significant. In fact, if you could see here, it's minus 4%, minus 4.1. It was also a period during which the risk premia went up a little bit. And so the risk premia had also a negative impact on net asset value, but it's smaller than the impact of rates, right? Because rates are very, very low. So the sensitivity to changes in rates is stronger. Meanwhile, changes in dividends have a much smaller impact on their net asset value. So here you understand first the importance of interest rate risk and how thinking about inflation in this context is really about thinking about interest rates and duration, and not so much about the correlation with revenue, because this is very imperfect. All right. And likewise, if you go to our platform, we have the same sort of analysis which we run every quarter, which breaks down for various segments of the universe the impact of rates, changes in cash flows, and changes in discount rates, in risk premia, on the net asset value in that particular segment. Okay, next one. There's no poll for this one. Is infrastructure investment risky? Okay, so this is actually, we just published a paper on that, which you see on the left-hand side. This is an interesting question because often infrastructure is presented as low risk. So how low risk is it? Okay, so the answer is, well, yes, it actually is risky, meaning you can lose some money. You can even lose all your money. When you come from infrastructure, when you come to infrastructure from the world of project development, project finance, construction, etc., the dinner parties you go to are mostly, the stories are mostly about how projects go widely wrong and how everything's went really bad in that particular case. In particular, traffic projections being widely over-optimistic, governments reneging on their commitments, counterparty defaulting, all sorts of things can happen, which can sink a project completely. So bankruptcy risk is real. And in fact, if we look at 20 years of data, we see plenty of defaults, we see plenty of dividend lockups. So this is situations where these companies are barred from paying out dividends by the lenders usually. And we see dozens of bankruptcies. So you can lose all your money, right? It's possible for airports to go bust. And what that means is that if bankruptcy risk is real, it means that market risk is real as well. In other words, before you get to that lower bound when the infrastructure company goes under, the value of that company changes. It varies. And that's because the risk premium for that company also changes over time. The discount rate changes over time. So this is not something to be very surprised by. I put in the table below, I put the returns and the volatility of a 30-year US Treasury bond index, okay? US Treasury bonds will have the safest cash flows you can think of, right? These are risk-free cash flows. But the volatility is 18%. And that's just because of interest rates. Interest rates change, the value moves. So there's volatility in this particular asset. The same thing applies to infrastructure. In fact, it's less volatile than those 30-year US Treasury bonds. But the possibility of values going up and down all the time for various reasons, because of cash flows, but also because of discount rates moving, is is a real thing, and it's something to take into consideration when investing in infrastructure. So likewise, we can track this once we start measuring the mark-to-market value of hundreds of companies every quarter, and I'll show you in a minute how we do this. You can measure this volatility, you can measure this risk. Roughly for the infrastructure asset class, for the infrastructure 300 index I was showing you earlier, we have a volatility in 10 to 12% range. This is actually not that high, but it's much higher than the volatility of, say, appraisals, which are not marked to market. We also get value at risk levels and max drawdown levels, which are between 20 and 15%. Which is good, which is something that would provide infrastructure investor with excuse me, with a good treatment under Solvency II, for example. But these are not zero risk investments. Okay. Next one, which also keeps coming back, is listed infrastructure a good proxy of unlisted infrastructure? So we've done a lot of work on this, but it keeps returning. So it's good to remind your dinner party friends that this is something that we know a lot about, and the news isn't very good. Listed infrastructure is a bad proxy. We've looked at listed infrastructure extensively. There are a couple of big problems. One, listed infrastructure indices, while you have some companies that are listed and that are genuine infrastructure companies, they're very biased towards a few sectors and a few countries. It's a lot of energy, a lot of US, basically. And that's the first problem. Second problem, they also can include lots of stuff that's not really infrastructure. So that's what we call fake infra, which makes these products even more noisy. In any case, once you look at the data, you find that it's perfectly correlated with the stock market. So that's what you see on the right-hand side. We take here one listed infrastructure index, but you could take any other. They're quasi perfectly correlated with equities or the various betas that you find in equity markets, meaning that they're basically the same thing or a subset of the same thing, and not this. So this is not a particularly interesting proxy of unlisted infrastructure. This is something we know well. And then the sort of flip side of that question, if you're not using a listed infrastructure index as a benchmark or as a proxy, well, shouldn't you just consider infrastructure to be an absolute return strategy? So this is the default answer probably of most investors today. Having established that listed infra isn't too good, having established that appraisals were not very useful either, because in terms of risk management, because they don't measure risk, you might as well just call this an absolute return strategy, give yourself some kind of hurdle rate, and away you go. The problem here is that this is also a fallacy. Infrastructure investment is not an absolute return strategy. In fact, an absolute return strategy is a market neutral strategy. It's something that has no relationship with the market. And as we now know, as I've just showed you, there's plenty of correlation with other developments in the economy or in financial markets, in infrastructure. The business cycle, which can kill a toll road, or interest rate risk, which can increase or decrease the valuations of these companies. The credit cycle also can change their availability of debt for these companies, etc. So there's all sorts of business cycles or financial cycles which impact these firms, and therefore they're not market neutral. Even though they may be less correlated than other assets, they're not correlated. We find, in fact, when we look at the returns, that we compute some correlation with bonds and equities, but limited, but significant correlation. There's also usually the approach or the argument for using an absolute return strategy is to say, well, this is illiquid, so we're just going to slap an illiquidity premium on the risk-free rate. So we're going to call it risk-free plus 5% or CPI plus 4%. But this illiquidity premia itself is a market price, right? Because this is the relative liquidity relative to other things. So even that is arbitrage between different classes. So it's not possible to say, well, this is always 4%. Going forward, maybe it will be 3% or 6%. I don't know. It depends. So using an absolute return strategy as a benchmark doesn't really allow you to manage this asset class very well. Either it's too easy to beat, and it was the case for a while. So CPI plus 4% was very easy to beat for the past few years until it became impossible to beat in 2020 because everything was negative because of the impact of COVID on the transport sector, partly on the power sector and utilities, and the general impact of COVID on risk premia, which just mechanically had an impact on asset prices. And so once the returns are negative, having a CPI plus 4 benchmark is just as meaningless as it was before. It's just more obvious. So these absolute return benchmarks are not the most useful thing to look at infrastructure. This is something that's a bit difficult to change because there are strong habits in this area. But I think increasingly investors are recognizing this, and we see it in the various surveys that we do also of investors. Okay, so now really getting to the heart of the reactor, so to speak, the heart of the matter, which is, well, okay, that's all very nice, but if we can't use listed infrastructure, if we can't use appraisals, if absolute return strategies are not particularly relevant to understand infrastructure, what should we do? Well, this is exactly what we created Edek Infra for and why we collected all this data. It's to try and arrive at an understanding of the market price of these companies, despite the fact that they are seldom traded, despite the fact that they are quite different from each other. And so if you wanted to price these companies and you went about this business the way you normally do, say, in real estate or private equity, you would try and find some comparable companies, and you would soon discover that there aren't any, because your airport that you're trying to price is very different from whatever airport traded recently, or maybe not so recently, because few airports trade anyway. So you're left, having no decent comparable to look at. The answer to this particular problem is to break down the prices that we can see, break down the transactions that are observable, because there are some. I mean, people buy and sell infrastructure all the time. There just happen to be these very different, very allegedly idiosyncratic assets. What if we break down the price of each one of those assets into systematic factors, if they exist? Then we can use these systematic factors to price all of that. Okay, so the answer to my question here, which factor explains the infrastructure equity risk premium, is the following. So I'll explain to you in a minute how we've done this, but we've found in the data, and that's looking at secondary market transactions, real prices that investors paid to buy these companies. We found 5 key equity-like factors that explain the value, explain the prices that were paid by investors for these companies. 5 factors plus a few what I call here TICS controls. So these are basically sector or business model control variables, right? So the 5 factors are size, the size of the company, and here I put the plus sign because obviously the larger the size, the higher, so in this case, the risk premium, right? So higher risk premium, lower price, right? So higher size, higher price, higher risk premium. And this is controlling for everything else, right? I'll come back to this in a second. But the impact of size is to increase the liquidity effectively. And so it's to make the asset more liquid and therefore a little cheaper, because you want to be rewarded for this illiquidity. Investment, which is a ratio of capex to size, capex to total assets, also increases the risk premium. So when you're in this period where infrastructure companies are being built, and you're sinking all this capital into the ground, you're taking risk, the equity risk premium is higher. There's a profit factor as well, which explains very well the transaction prices. And this one has a negative impact, meaning that the higher the profitability of these companies, the lower the equity risk premium, meaning, of course, the higher the price. There's a leverage factor. The more leverage they are, the higher the risk premium. That's pretty obvious, right? As an equity investor, you're exposed to more risk if you have a more leveraged company. And again, this is controlling for everything else. We have a country risk effect, which we capture using the term spread, but whichever way you want to model this, some countries are riskier than others, which makes sense because this is a lot of the regulatory risk and policy risk is a matter of jurisdiction. And then you have these sector effects. For instance, renewables, irrespective of all these other effects, renewables tend to be expensive. So the premia is lower and the price is higher. Merchant companies, which have a merchant business model, right? So collect tolls or sell power in a power pool or whatever. These are higher risk premium and therefore lower valuation because they're riskier, etc., etc. Okay. Why is it like this? Well, infrastructure is traded in markets. Okay, and in markets, prices are traded by systematic risk factors. This is almost an unescapable reality. Unless there was only one asset that was traded, and then it could be all about what the seller and the buyer think about its value and have nothing to do with anything else. From the moment that you have multiple transactions with multiple investors buying and selling things from each other, arbitraging with other asset classes, it has to be the case that there are some systematic, it's just statistics, systematic effects that drive the value, okay? And here it works very well. The models are very powerful. I'll show you the robustness also in a second. And then why are these factors? Well, it's equity, right? Size, profit, leverage, and these terms pretty familiar, right? And this is what Farmer French or Modigliani Miller would kind of suggest. And so we're not too surprised to find these effects in the pricing of these companies. The point here, again, is that now that we can do this, we can price anything. So let me just explain that again. Let's say we can observe some expected returns in secondary market transactions. So I can see some prices. I can see people buying and selling infrastructure because I have this data. And from each one of those deals, I have an IRR, an expected return, okay, a discount rate. From this IRR, I'm going to extract a risk premium because in that country, at that point in time, I'm going to extract the risk premium from the equivalent, using the equivalent term structure of risk-free rates, and I'll have a premium for that deal. Okay, so I see lots of deals. I see thousands of deals. In fact, more than 1,000 over 20 years. So hundreds and hundreds of deals. And then we break, as we observe this data, we break it down into these risk factors, these betas, right? And so to each one of those risk factors correspond the price. So for example, my company has, this company has a certain size and it has a certain leverage and a certain profitability. And it means that the premia, the price of each one of those risks, must be X in order to explain the price. Okay, and so you do this again and again and again and again as you observe these assets and being sold and bought, and then you get a time series of risk premium of prices of each factor. Now, all the assets that I also have information for, but that have not been traded the last month or last quarter, for which I know the size, the leverage, etc. What I have to do now is multiply their exposure to one of those risks, so their factor loadings, to the price of these risks, and hey presto, I have a market-to-market risk premium for that company at that point in time. Because the price of risk is the same for everyone. The only thing that changes is the exposure to that risk. And so going about it this way, we've solved the problem of having too few observations in a very liquid market to something that can be reduced to a factor model with a bit of econometrics. So these factors explain the risk premium. So for example, here on the left, you see the leverage factor. So let me give you also a bit of subtext here. In this sample, in this data that we're looking at, over the past 20 years, since 2000, the leverage factor loading, so the average leverage, has been very constant. It's roughly 75 to 78% on average. It's infrastructure, right? There's lots of debt in there because it has stable cash flows. Yet you see on that picture that the marginal impact of that premia, of that risk on the discount rate, is going down all the time. That's the effect of prices going up and up and up, and discount rates, so yield being compressed over time. You can see here 3 lines. You can see this effect for companies that have low leverage, so I think it's less than 60%, and companies that have high and medium leverage. And for irrespective of how much leverage they have or how leveraged they are, you see that the effect isn't exactly the same, but it's always trending down over that period, except in bad times. So during the GFC in 2009, the price of this risk, which is a bad thing during a financial crisis, goes up a lot. And then it keeps going down again. And then in 2012, during the Euro crisis, it spikes again. During COVID, it spikes again. So this is the price of risk of the leverage factor. It has decreased a lot because investors are willing to pay more dollars for the same risk. But tendentially, it has been decreasing a lot over that period of time, right? So basically, investors have been less worried about leverage, less afraid of leverage over that period, even though they do get afraid during bad times like COVID or the GFC. On the right-hand side, you see the same sort of picture, this time for the investment factor, right? So the investment factor, I was saying, was the ratio of capex to total assets. So the high investment means it's basically those companies that are in the greenfield stage, and the very low investment, the sort of orange line, are companies that are at a very advanced, mature state of investment and don't invest that much. And here you can see, of course, that there's a big difference. The higher the investment, the higher the premia, but there isn't nothing like the secular decrease that you see on the leverage side of things. This is a factor that has remained much more constant, if not persistent, in fact, over that period. So let me not spend too much time on this because we have papers on this and etc. But the point here is to show you that it's possible to extract from market prices information about what drives these prices, and then you can use it to price any infrastructure company. Does it work? Yes, it does. So here you see the difference between the valuations that we predict with this model and the valuations that we observe. And of course, it's not perfect. It's not perfect because we don't have a crystal ball, and it's not perfect because some of these, a part of this valuation, a part of these prices that are being paid is idiosyncratic. There are some reasons why investor A or B will be willing to pay more or less for this asset because they really like it, or they got a great deal, or various reasons. Risk preferences are different. They're at the right place in the right time, or they're in the wrong place in the wrong time, and they pay something way too expensive. But that's not what drives most of the price. What drives most of the price are these systematic factors. And on average, the error that we make, so the difference between the prices that we predict and the prices that we observe, is that the model predicts is very small. It's 0, and the range of errors is plus or minus 5%. So what this shows you is that you can explain why people pay how much they pay for infrastructure companies as a function of systematic risk factors. And this then predicts valuations very well, okay? This is important because it means that we can now start to think about marking to market on an ongoing basis, which is what we do. Okay, so now that we can do this, we can ask ourselves some more amusing questions, like what is core plus infrastructure? Because now we have all this data, we apply this technology, we price hundreds of companies every quarter, every month, in fact, now. And so we can start to look at this data and say, okay, so what do we mean by core plus infrastructure? So the answer to this question is, as you know well, no one seems to be really sure that what core plus infrastructure is, because there is no definition. And as I like to point out, one of my favorite games on a panel is to have 2 core plus managers and to ask them to compare what they do, and usually they do something completely different. But it doesn't matter. We can try and think about this in a more constructive way, also more transparent way, which is to say, okay, what do we mean by core plus, value add, etc.? These are terms that we inherited from real estate, which are indicative of risk appetite, I think. When you do core, you want the stuff that doesn't move too much, and then the further you're willing to go from core, the more interested you are in risk, right? So we took the entire distribution of expected returns in the universe that we track, right? And we sliced it in quartiles, and we said, okay, core is the first 2 quartiles. The third quartile of expected returns is core plus, and the rest is value add. So these expected returns, which are these discount rates at each point in time, right, that we see in the market, they should tell us how much risk and what how much exposure to risk the market is pricing in each asset. Okay, so if we slice the universe in this way by quartiles of expected returns and call them core, core plus, and value add, we get something like this. So here I show you at the end of Q1 this year in local currency returns, our broad market index, which is 538 companies, has negative returns in Q1 because of higher interest rates, has negative returns on a 12-month basis because of both rate and COVID, but otherwise has decent 5-year returns and a Sharpe ratio of 0.6 and a value at risk of 16%, okay? Then you look at these 2 next lines, core plus and core and core plus, and here you can see the difference in profile. Core, because by the nature of the definition, right, but it now makes perfect sense, has positive returns on a 12-month basis, has a much better Sharpe ratio and lower volatility. It is also a bit less exposed to interest rate risk. The duration is working. It's pretty close to the broad market. But what's interesting in that core plus has much higher duration and also greater equivalent volatility. So here we can that's just to show that having done all this work, you can then begin. You can keep the notions of or the shortcuts of core plus, etc. But use these things to use this data rather to define these things much more clearly and much more granularity, and then they become usable in the investment process. Related to that, what is the right hurdle rate for an infrastructure fund? Okay. Well, the answer is the expected returns, which is just like my core and core plus question. The hurdle rate should be the average expected return for a strategy. So say a fund is going to do, for example, investment in renewable energy. Well, what's the expected return in renewable energy? And then that should be the hurdle rate. And then if the manager is really good, they will beat that. And if they're average, they will deliver that. And if they're not so good, they will be underneath that. Unfortunately, when you look at funds today, hurdle rates are still set pretty much by copying and pasting the documentation from the previous fund. As far as I can tell, there is no difference between core, core plus, or opportunistic, and there's no difference over time. It's 8%. I know there are some exceptions to that. I know there are some more recent funds that have lower hurdle rates, or that some of the more successful asset managers have managed to negotiate with the LPs a lower hurdle rates. But basically, everybody else is stuck with 8%. And of course, the market implied hurdle rates that we get are sometimes 8%, but sometimes not. And if you want to invest, for example, in renewable energy, it's closer to 6, right, or 7, but certainly not 8. Now, why is this an issue? It's an issue because it will lead the managers probably in order to beat their hurdle rate, which is not mark to market, to drift into some strange stuff. Either they will do things that are like infrastructure, but are really private equity, or they will add leverage here and there, or whatever they do, they will have to stray from their original mandate. And instead of being invested in nice real assets, which is what the LPs initially wanted, by imposing very high hurdle rates, they end up being invested in lots of financial risk. So not ideal. And I think this also contributes to the accumulation of dry powder. Dry powder in infrastructure has been building up much faster than fundraising. And this suggests that high hurdle rates are partly to blame, because obviously you have to let a lot of investment pass if your hurdle rate is ad hoc and doesn't match the expected returns in the market. Right. I'll move on to the next one because time is running a bit short. Last one and last question for the audience. Is infrastructure, actually, that's not the last one, it's the penultimate one. Is infrastructure too expensive now, Brandon?
Yeah. And to be clear, this is infrastructure equity.
Yes.
Frederick. Yeah, I'm very moved. I'll be coming back to you on your last point. I wonder if it's related to the expense, this dry powder, too much dry powder distorting the price of supply. But let's pause for now. 5 choices here, folks. Let me start the poll for you. No, it isn't. Probably isn't. Not sure. A great question, a great answer rather, that you don't hear enough of in our industry. I'm not sure. Probably yes. Definitely for those who are super confident. I wonder if your previous point about hurdle rates, Frederick, will have pushed people more towards definitely. They're hedging their bets a bit at the moment. I'm treating it like a horse race, you know, the runners and riders are off. Probably yes has got half the votes. And just as I say that, they pull back.
Well, what's great is that we're getting great sample sizes today.
Well, that's the joy of IPE real assets. What a great combination. Edek infra and IPE real assets.
What else?
We've got some questions, by the way, Frederick, so don't worry about overrunning. I use this phrase 60 minutes, or this time period 60 minutes. You're offering so many riches, educational riches, to the audience today. I think we deserve some more question time, so we will overrun. Don't worry. Do comment on what you see before you. I'll leave the polls open for 10 seconds more. We're going to get nearly 90 responses, but probably yes. I wonder if you've influenced it, Frederick. I don't know, or maybe just people.
I don't know. I think people have not been listening.
You frequently in this quote unquote lesson, that's been your phrase, hasn't it? Yeah. Carry on.
Well, as one of my favorite professors would say, you are normal human beings. No. No. So the real answer is, I think we're done, huh? Yeah. We're gonna probably yes. Actually, no. We have 2 groups here. We have those who say no and those who say yes. It'd be interesting to know if they belong to different crowds. The answer is, I think, and this is more subjective. No. Why? Because I've looked at this for quite a while, and I've looked at the data going back even further. And objectively, these companies, these investments, 15 to 20 years ago, they were cheap, sometimes dirt cheap. You know, governments are famous for selling the crown jewels for close to nothing. And in some cases, all you had to do was roll into town and someplace in, you know, Western Australia, and I don't know, take somebody out to dinner, and then you could walk away with the port for the book value. Now, I'm caricaturing, but it's almost true. Meaning that these assets used to go for very low multiples, and it was only natural that over time, as more parties became interested, as more competition built up, that they would become more expensive. So as this asset class, which didn't exist really 20 years ago, 15 years ago, became a proper asset class, you could say that it's been through a period of repricing, but it's not it's not wrong that it's more expensive. Instead, you could say that infrastructure should be expensive, because if it's the case that infrastructure pays out a lot of money, that in the grand scheme of things, compared to other asset classes, it's reasonably low risk, even though I told you that it was, you know, not zero risk. But it remains, the Sharpe ratio is very good, right? The risk return reward remains pretty attractive. Then this is a valuable asset. I want to own something that will pay me with reasonable predictability some high dividends in 20 years' time, when I need to pay out the pensions of the Oklahoma Fire Brigade in 20 years' time. So this is a valuable thing. So I should be willing to pay a lot of money for this now. So it's normal that prices went up as this asset class developed and became institutionalized. And then if you look at the numbers, the cash yield is still pretty great, right? So the cash yield is somewhere between 6.5 and 9%. If you look at core or core plus, what I just showed you as defined as core or core plus. And so that doesn't sound like overpriced to me, right? So that's my answer. That's that, and you don't have to be convinced. But I think the combination of understanding the sort of history of the asset class and why it became more expensive, and then seeing how prices basically stopped going through the roof every year 2 or 3 years ago, and that the yields remain pretty attractive, doesn't sound to me like it's overpriced. However, it's not cheap, but that it probably should be expensive, given what it is. So this is the discount rate and the risk premia. So that's a component of the discount rate for this Infos 300 universe that goes in the Infos 300 index. And as you can see, so a bit like I was showing you before, for each factor, it does go up in bad times. In fact, the discount rate has gone up above 8% recently, just only the last quarter. But for a while, it was way below than that, and it's still very decent. Sorry, not way below. It was below, between 6 and 7, and it's still I would say a reasonable level of expected return, not something that's widely overpriced. And again, if you want to see more details about this on our platform, you can see all these price ratios and all these expected return numbers for the global asset class, and also for all these various segments. Final question: does infrastructure always have a role in the total portfolio? So here, this is one of our most also recent paper. We, having measured the performance and therefore the volatility of these assets, we could now compare them with other assets. See, that was the problem before. We used listed infrastructure, which was perfectly correlated with stocks, and we had a portfolio optimizer saying, "What is this thing? We already have it. You don't need it. It's stocks." Or if the Sharpe ratio was ever so slightly better, sell all your stocks and just buy listed infrastructure. It was something completely silly, basically, because the correlation was so perfect with stocks. Conversely, if you used appraisal-based indices, which have very low volatility, because they're very smooth, in fact, completely unrealistic volatility, and you put that in an optimizer, the optimizer would say, well, that stuff has a Sharpe ratio of 3, and it's correlated with nothing. This is pure gold. You should sell everything and buy just that, which is also completely silly, obviously. So now that we measure a reasonable level of variability of the valuations of infrastructure, and we get Sharpe ratios, for example, which are not completely stupid, we can do something like measuring infrastructure in a strategic asset allocation context. So the answer to the question is, does it always have a role? Well, yes. In the case of equity, so it depends what kind of investor you are. In the case of equity, we have decent correlations with equities and bonds, which create opportunities for diversification in a portfolio. So it's worthwhile having infrastructure in the asset mix, given that it also has an attractive risk-return profile. And in the case of debt, the risk-return profile is even better, in fact, compared to bonds. And so this is quite useful for an investor that needs to lower the cost of hedging liability. So building a liability hedging portfolio while benefiting from a better Sharpe ratio, basically. So we did in this paper, we do a bunch of tests. One of the most interesting exercises at the end, where we take all the sort of average view of the market for forward-looking returns, volatility, and correlation. So it's not us, it's just all these names that you can see here. We take all of their data to inform a strategic asset allocation exercise, forward-looking. And we use the Infrastructure 300 index and one of our private infrastructure debt index build an optimal allocation. So there are multiple cases in the paper, but here I'm just going to show you a return targeting approach. So you target a specific return and minimize volatility. And here are the two interesting results. One, at the bottom of the table, if you look at the last two lines, you see that when you go from no infrastructure to with the infrastructure, the Sharpe ratio of the portfolio is better, is significantly better. So having infrastructure in the portfolio does something positive for the portfolio every time, irrespective of whether you're a sort of 60-40 higher risk return, a higher risk investor, or 20-80, so 20 equity, 80 bonds. Lower risk type of investor, irrespective of your profile, you find that it's good to have infrastructure, and it's good to have as much as 10% in your portfolio. And there are very few constraints, I have to say, in this exercise. The constraint on the liquid assets is set at 20%. And so we're not hitting the binding constraint or anything like that here. The difference is that if you're a 60-40 type investor, so if you have higher risk appetite, right, 60 stocks, 40 bonds, so that's your profile. You want basically all infrastructure equity in your portfolio. Whereas if you are a lower risk appetite type investor, so 20 equity, 80 bond type investor, you want basically almost only infrastructure debt, a bit of equity, but mostly debt. And that's because they play obviously a different role, and they interact with the other asset classes in a different way. The reason why the other classes behave the way they do, again, in this exercise is not up to us. It's just the data that we got from what you might call the market consensus. But the interaction with infrastructure, debt, and equity is very interesting. Okay, so let's review for your future dinner party. What should we have in mind? Infrastructure tends to pay out a lot of cash, so that's good to know. But you need to take some risks. Okay, it's not a free lunch. These risks include business risks, of course, which will impact those cash flows. So this is usually how people think about risk in this sector. It's possible that the toll road doesn't have quite as many cars driving on it, or quite as many, not quite as many planes driving. Flying to and from the airport. But this is actually not the only thing that drives these risks. One of the other two things are the market risk premia. And this is something that changes over time, and I showed you, as investors decide to price these assets differently, and also the impact of interest rates, which is significant because these are high duration, 20, 30, 40-year investments. Inflation hedge, I don't think so. Again, I stand to be corrected, but at the moment there is no evidence in the data, and even just thinking about it logically, it doesn't really add up. Listed proxies, you can also forget about, but you shouldn't forget about finance, modern finance, and you should try and think about these investments in terms of systematic risk factors that drive the prices, because in the end, this is how investors invest. They buy things on the basis of how risky they are, and well, they pay on the basis of how risky they are. And this is by the nature of a market, has a systematic dimension. In fact, this explains most of the price, as it does for other assets. As a result, absolute return benchmarks, not really the best idea. Fixed fund hurdle rates either. Instead, you could use something that reflects the market price of risk over time. Even if you don't reset it every month, you could reset it every 2 or 3 years, but at least you would match better the market conditions and the relationship with other assets, which means that, again, in terms of arbitraging across your portfolio, you will invest more in infrastructure, and you will also compensate more fairly whoever invests in infrastructure for you. Next, if you really have to use core and core plus, I would prefer if you use TICS, of course, but if you really have to use core and core plus, which is fine, try and use a reference which is based on risk and not sectors, because these bands by risk are very homogeneous and consistent, whereas sectors are not. Some sectors are high risk, some sectors include all sorts of assets, some of which are high risk, some of which are low risk, depending on how they're set up, what kind of business model they have, et cetera, et cetera. And so saying that, for example, transport is core is meaningless. Core means, if core means low risk, then you can't just say transport is core, because there are plenty of high risk transport, and there's also plenty of low risk transport. And finally, if you already have bonds and stocks in your portfolio, you could probably invest in infrastructure. I mean, it's probably always the case that you should invest in infrastructure. That should be a good idea for your portfolio. And finally, do not worry about the price bubble, because there isn't a price bubble. Just be careful how much you pay. And if you want to know more about that, we have plenty of analytics to help you decide. Voila. So, okay, contact us if you have any questions more later than today. We're going to do Q&A now, of course, but feel free to get in touch with us and check out our various websites. And if you're interested, we can produce these indices. We can also tailorize those indices for your company. You can access them through various means, through Bloomberg, through Aladdin, etc., etc. And later this year, we'll have some more exciting products coming out. But I'll come back to tell you about these later. Anyway, that's what we do.
Yeah, let's leave up this slide, Frederick, just to tackle the first question. It comes from Zimbabwe.
Okay.
The wonders of the internet, investment and pensions Europe, global infrastructure. Question from the Zimbabwean Parliament, no less, from Senator Dr. Bekithemba Mfofu there. And he just simply asks, is TIC freely available? So here you can distinguish what you can get for free and what you have to pay for.
So the answer is yes. TICS, the taxonomy, so the infrastructure company classification standard, which is we use and we've developed, but is actually ran by an independent review committee, which is headed by the Royal Institute of Chartered Surveyors, and it includes a whole bunch of investors on the review committee, because there's a market consultation and a review every year. But it's a standard, right? It's a framework, and yes, it's free. It's available also on our website.
Okay, and thank you to Dr. Mfofu for listening in. I hope that helps you. Let's go back actually, and I'll just end the slides if that's okay. Maybe we might flash up those contact details again, Frederick, before the end of the show. But a couple of points. One off, you kept saying that you weren't sure if the audience were infrastructure investor professionals. So you've said throughout, you mentioned appraisals. I know we're going back a bit to sort of the ABC, but it's maybe worth saying this is in contrast to the market-based prices that you prefer and that the factors help you to model. Just to explain what appraisals are to the audience.
Right. Well, appraisals is very simple. Consists of providing a net asset value for an asset on a regular basis, usually quarterly, even though if you look at this data, it's really revised once a year, because there's big seasonality in this data. And it consists of taking some kind of cash flow, future cash flow base case, which can be revised. And for instance, with something like COVID, you have to revise it because obviously things are different. And then discounting these cash flows with a number, a discount rate. And this is where the issue really lies, which is that these discount rates are very smooth, right? They barely change, or they change very slowly. That's because the approach is quite different. It consists of trying to find a sort of consensus number that the investor themselves believe is the right number, but it doesn't have to do anything to do with the market, really. So the way the discount rate is done is usually by applying a very long-term series of risk premia and risk-free rate, which means that the valuation that is derived from this, again, changes very slowly over time. It's almost booked at cost, basically. The problem is that if you look at this data and you look at the volatility to rewards, the risk-reward ratio, you get something that looks like a Maddox hedge fund. So it's obviously wrong. The volatility has to be higher, or something is completely bizarre, because something that has a Sharpe ratio of 3 or 4 for 10 years, there's no problem.
It's crazy.
Yeah.
And I'm not very good at maths, and I know that. The issue then is, just to clear off appraisals, is it just it's an industry tradition almost? If you asked every infrastructure investor what value can I place on appraisals, they would probably agree with you and say, well, we kind of have to do them. There's something worthwhile in them, but it isn't in terms of discovery.
The thing is, this is the only thing that people had at their disposal until recently, because it's easy to say, oh, well, your data is smooth, whatever, but yeah, okay, what else do you have? Like, as I was saying, if you use listed infrastructure, you get something that's also wrong. So that's why we created this project 5 years ago, and only for the past 18 months or so has this data and this technology been available to produce a much more accurate assessment. But so it's not so much that people are not trying, it's that the effort to collect the data and to process it hadn't been done.
Yeah. And if I just go back to the very beginning, the building blocks, your methodology, do the I was going to say contributing projects or companies in the infra universe, do you take their data or do they give it to you? How much coordination is there? And also, has this changed over time? Because as you grow, people say, well, we like you, and it starts to become symbiotic, a bit like credit agencies.
Very important. So when I started this work, I was aware of all the other databases of private assets, which all contributed. And they all have the same problem as a result of being contributed. They're biased towards whoever reports, and that includes selection bias, but also survivorship bias. So you only get one kind of data, basically. And we wanted to avoid that very much, especially since infrastructure is probably less... there are fewer assets in the world than, say, in real estate, right? So if we're only going to get a few things, and they all happen to be the winners, for example, because the best asset managers are only the ones who are happy to give us some data, we're not going to have a very representative view. So we went completely the other way. When I say that we track 650 companies, these are 650 companies for which we have access to their financials through various means, but basically you can get their financials, and where we add value is that we've read them. We've read the 150-page audited accounts for the project, the wind power project XYZ for the past 15 years, every year, and we've aggregated all this information into a data system, along with the information of every other company that we look at. So we get the data. It's a bottom-up approach, if you want. We select the information in order to be representative of the market, and then we aggregate the data from the financials, which means that we don't have this problem of survivorship bias or reporting bias. Yeah. This being said, as you said, as we develop these services, we have more and more users of our data that also contribute some information. But we're quite careful. So we usually we do this in order to help them build some kind of, for example, customized portfolio, customized index, or something for them. But we're careful not to let too much information coming from one, say, contributor influence the indices, for example, or become the index of asset manager Y, because then they create other issues, and then you're back to being influenced by our contributions.
Understood. Super. I must get on to ESG, because we had a question that came in right from the start. So I'd like to thank Josian van der Meer from Akerlof, a firm I know, great firm. So thank you for the question, Josian. And that is, to what degree is ESG or sustainability information included in TICS? Has the EU taxonomy made much of an impact yet, or is that on the horizon? Great question, Josian. Thank you.
Yes, very topical. So we started our work on ESG and sustainability 2 years ago. And earlier this year, we published a taxonomy of ESG impacts and risks for infrastructure companies. which is basically an extension of TICS. So in TICS, you have multiple pillars, and one is industrial activity. Activity, keyword. This is also a keyword in the EU taxonomy. And then for each one of those activity, we have created a ESG risk and impact taxonomy, so a second taxonomy, which we're then implementing now to try and measure certain of these sustainability risks. So yes, we have integrated the EU taxonomy and sustainability in TICS, but it's a kind of a branch, a new branch that's coming out of that tree, and it will only start to bear some fruits in a year or so.
Okay, so that's
but
not
the taxonomy is public. We published it in March.
Yeah, but that's not one of the exciting new projects that you're going to talk about later in the year.
No, that's yet another thing.
I'm just trying to cough it out. Sorry, I'm a journalist, Frederick. Thank you for that. Super. And I think we've also covered the same sort of question from Terence Bearcliffe from Sustainable Screening. But thank you, Terence. I hope Frederick's answered that question. I should say, you got those details. This webcast is available on the IPE Real Assets site for the foreseeable future. It's also available on Bright Talk, and those contact details from Edek Infra will be up there. You can tell Frederick is waiting to get your call. So more questions, don't hesitate to contact him and his colleagues. Quick one, I think this is a yes or no one. Frederick, does Edek offer a pricing service to price transactions?
Effectively, yes, but because that's what we do all the time, but only on a not very customized basis. It's there. You can't just go to our website and put in your assets and get a price, but we can do it.
Now, in spite of very clearly explained to you explanation why infra is not an inflation hedge, we've someone sort of come back nevertheless and ask, are there any infrastructure sectors that stand out as generally being particularly good inflation hedges? So I'll make that more elegant. Any that break the general rule?
PFI, probably. So because there's a 100% CPI hedge, and the financial structure is very simple, so you're quite likely to find some of that correlation in the dividends as well, but not guaranteed.
Okay, super. Question from me now, Frederick, and forgive me being simplistic. I found something of a paradox. On the one hand, we have these, what could we say, generalized promises when we looked at core plus, and you said I can't see the difference, and that suggests to me again the industry sort of following a tradition and not actually taking into account all the factors that Edek Infra does. And then you're saying at the end though that fundamentally infrastructure equity is not overpriced. People need more of it. So how do we balance this difference between the fundamental salient attractiveness, get it, I'm taking a step forward, with that qualification that there's, what did you say, $200 billion worth of dry powder sat there because people, I'll say over-promising. I mean, that's not quite accurate, but
no, it's not that. It's just that it's been difficult to. It doesn't come naturally to standardize the language. It doesn't come naturally to provide good benchmarks when there's no data. So this is an industry that has had very little data for years, and so it did what it could. It carried on the basis of a good story, and in some cases, very good track record. In other cases, less good. But they're all based on we expect it. I think Canadians like to call this investment beliefs. We expect it to be this way. So if we if we get the best manager, it will probably pan out that way. So what's different now is that we can try and look at these things a bit more clearly, a bit more granularity, and compare things that are comparable more easily.
Yeah,
but it's not incompatible to say that you need more infrastructure, and that it's difficult to benchmark well. But look, hopefully with our work, it's less difficult.
Yeah, but you make a good point regarding investment beliefs and people buying a story. I don't say that too pejoratively. Yeah. What I'm going to do, if it's okay, is just bring back up I think I'll bring up these contact details, if that's okay, Frederick.
Sure.
Just so live people know to whom to send their email to launch more, because some of the questions coming in, we're going to stop now, folks. We've overrun, but for all the right reasons. It's been a terrific presentation by Professor Frederick Blancpoid from Edek Infra. These are the contact details. I'm sure that Edek Infra will be reaching out to some of you in the days ahead. If you want to reach out to them, here are the details. I think, Frederick, I'm going to let you go now. It's not quite dinner party time here in Europe. I know
it's getting close here.
I know where you're in Singapore. You can put on your tuxedo and go out and answer all those questions from your guests.
Well, as you can see, the sun is setting over Singapore, and unfortunately, we're still in lockdown. So
okay, it's a virtual.
I'm gonna have to go home and
put on your tuxedo and
put on my tuxedo,
and then click onto BrightTalk or Zoom and give your other dinner guests the right answers virtually, safely at a distance. I'd like to thank you for a terrific presentation, and this will be available on the IPE Real Asset site for the foreseeable future and on BrightTalk. If we didn't get to your question, apologies, but I think you'll be able to contact Edek Infra, or they'll be able to reach out to you. This is Brendan Mayton for IPE Real Assets, wishing all of our viewers a very good day.
Thank you.